Accounting can seem like a foreign language, but don't worry, it's easier than you think. At its heart, accounting is simply about keeping track of your money. To do this, we use something called accounting accounts. Think of accounting accounts like labeled boxes where you organize your financial information. Each box represents a different aspect of your business's finances. We have boxes for things you own, money you owe, and much more. These accounts help us understand where our money is coming from, where it's going, and what we have to work with. It's like having a clear map of your financial situation. In the following sections, we'll unpack each of these boxes and see how they all fit together. Let's start with assets. Assets are things your business owns that have value. This could be anything from cash in the bank to equipment you use to run your business. Some common examples of assets include cash. This one's pretty straightforward. The money you have on hand. Inventory. The goods you have ready to sell to customers. Equipment. This could be anything from computers to delivery vans, property, buildings, or land owned by your business. Understanding your assets is crucial because they represent the resources your business can use to generate revenue and grow. Now let's talk about liabilities. Liabilities are the flip side of assets. They represent the money your business owes to others. Examples of common liabilities include loans, money you've borrowed from a bank or other lender, accounts payable, money you owe to suppliers for goods or services, salaries payable, unpaid wages owed to your employees. Keeping track of your liabilities is essential because it tells you how much of your assets are financed by debt and how much you need to pay back in the future. Equity represents the owner's stake in the business. It's what's left over after you subtract your liabilities from your assets. In simple terms, equity equals assets minus liabilities. Equity can be thought of as your business's net worth. For example, if your business owns $100,000 in assets and has $40,000 in liabilities, your equity would be $60,000. This $60,000 represents the owner's claim on the business's assets. Section 5. Revenue, money coming in. Revenue is the lifeblood of any business. It's the income generated from your operations. Revenue can come from various sources such as sales, which is the money earned from selling your products or services. Interest income, which is the interest earned on money you have in savings accounts. And rent income, which is the payments received from renting out property. Tracking revenue is crucial for measuring your business's performance and making informed decisions about pricing, marketing, and future investments. Section 6. Expenses, money going out. Where revenue is about money coming in, expenses are all about money going out. These are the costs your business incurs to generate revenue. Expenses can be broken down into various categories, including cost of goods sold, the direct costs of producing the goods you sell, rent payments for using office space, warehouses, or other facilities, salaries, wages paid to your employees, utilities, costs for electricity, water, and other utilities. Managing expenses effectively is critical for profitability. Understanding where your money is going allows you to identify areas where you can cut costs and improve your bottom line. Section 7. The accounting equation, a balancing act. Now that we've covered the basic types of accounts, let's see how they all fit together in the accounting equation. The accounting equation is the cornerstone of accounting. It shows the relationship between a company's assets, liabilities, and equity. The accounting equation states, assets equals liabilities plus equity. This equation must always balance. That means that any change to one side of the equation must be accompanied by a corresponding change on the other side. For example, if you take out a loan to purchase new equipment, your assets, equipment, will increase, but so will your liabilities, loan. Similarly, if you use cash to pay off a loan, your assets, cash, will decrease, but so will your liabilities, loan. Section 8. Recording transactions, putting it all together. Every business transaction impacts the accounting equation in some way. To keep track of these changes, we use a system called double-entry bookkeeping. In double-entry bookkeeping, every transaction is recorded in two places, once as a debit and once as a credit. Debits and credits are simply ways of recording increases or decreases to different accounts. Here's a simple example. Let's say you sell $1,000 worth of goods to a customer on credit. This transaction would be recorded as follows. Debit accounts receivable asset, $1,000. Credit sales revenue, $1,000. This entry shows that your assets, accounts receivable, have increased by $1,000, and your revenue has also increased by $1,000. Notice how the accounting equation remains balanced. By consistently recording transactions using double-entry bookkeeping, you can maintain accurate financial records and gain valuable insights into your business's performance. Section 9. Conclusion: the foundation of financial understanding. Understanding accounting accounts is fundamental to managing your business's finances effectively. By familiarizing yourself with the different types of accounts and how they interact within the accounting equation, you can gain a clearer picture of your business's financial health. This knowledge empowers you to make informed decisions, track your progress, and ultimately achieve your financial goals. Remember, accounting is not just about crunching numbers, it's about gaining a deeper understanding of your business and using that knowledge to drive success.